What if I told you that most millionaires in the United States did not invent an app, did not win the lottery, and did not come from rich families? They followed simple financial rules consistently over time. In today's video, we will learn how money really works in United States, how beginners can start investing from zero, and the same long-term strategy every day Americans use to build wealth. This is not a get-rich-quick video. This is how real money is built. Let's begin. In the United States, saving money alone is not enough. Saving protects your money, but investing is what grows. Inflation slowly reduce is the value of cash every year. If your money is earning nothing, you are actually losing purchasing power. For example, if you keep $10,000 in a savings account for 10 years, its real value decreases. But if that same money grows at 8 to 10% annually through investing, it can double over time. The U.S. financial system is designed around investing. Retirement plans, stock market access, and tax advantages all encourage people to put money to work instead of letting it sit idle in America. Investing is not optional, it is necessary. Many people avoid investing because of common myth. The first methods that you need a lot of money to start. In reality, many Americans began investing with as little as $50 or $100. The second myth is that investing is gambling. Gambling is guessing outcomes. Investing is owning real business that produce value. What time? The third myth is that the stock market is too risky. The truth is that not investing at all is often the biggest risk of all. To understand wealth, you must understand income. Active income is money. And by trading time for pay, like a job or freelancing, it stops when you stop working. Portfolio income comes from investments like stocks and funds. This income grows even when you are not actively working. Passive income is money that continues to come, and with minimal effort, often from long-term investments. Most wealthy Americans focus on portfolio income, not just salary. For beginners, the best investments are simple. Index funds are one of the most powerful tools for building wealth. They track the overall U.S. stock market instead of individual companies. This means instant diversification, lower risk over time, and very low fees. Historically, the U.S. stock market has returned around 10% per year over the long-term exchange. Traded funds or ETFs work similarly. They allow investors who buy a basket of stocks in a single purchase and are easy to hold for long periods. Individual stocks can offer higher returns, but they also carry higher risk. Beginners should approach individual stocks carefully and keep them a small part of their portfolio. One of the most powerful forces in finance is compounding. Compounding means your money earns returns, and then those returns earns returns again. For example, investing $200 per month at an average annual return of 10% of 30 years can grow into more than $400,000. Time matters more than timing. Starting early is most important than starting big. Many investors fail not because of lack of knowledge, but because of mistakes chasing hype stocks. Panic selling during market drops and trying to time the market often leads to losses. Emotional discussion destroy long-term returns. The market rewards patience, discipline, and consistency. A simple strategy works best. First, build an emergency fund that covers 3 to 6 months of expenses. This protects you from needing to sell investments during emergencies. Second, start investing in diversified index funds or ETFs. Third, investment regularly every month regardless of market conditions. Finally, hold your investments for the long time, 10 years or more. Allows compounding to do its work. Consistency. Bits, intelligence. You do not need a perfect timing. You do not need expert knowledge. You need discipline. Patience and time. Building wealth is not about luck. It is about decisions repeated over years. Thank you for watching.